Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA Enraja, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India, worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice, had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executives. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. In this video, we are going to do some fundamental ratio analysis of Infosys Limited. So this is the annual report on the left hand side. Right hand side, I'll do some basic calculation so that we can understand their fundamentals like profitability, liquidity, short-term solvency, long-term solvency, everything. Okay. So this is the balance sheet. Actually, it starts from here. Okay, hope this should help. So we start with non-current assets. They have property, plant and equipment, right of use assets, capital work in progress, even goodwill. And I hope all of you know, we cannot account for self-created goodwill. Only when goodwill arises from acquisition, we can account for it. Then they have intangible assets, okay, financial assets, quite a few. So this makes their total non-current assets, and current assets are basically investments, trade receivables, cash and cash equivalents. Yeah, since they are into service oriented activity, they cannot have inventories. Okay, so that's about their current assets. Then let's look into their equity and liabilities. Okay, equity and liability, equity share capital, other equity. Okay. There is an increase in other equity, so that can be on account of retention of profits. That we'll understand when we look into the income statement. Then look at their non-current liabilities. Okay, there is a increase. Okay, almost 1,200 crore, I believe. Your figures are in crores. Then if you look at the current liabilities, yeah, there are trade payables, lease liabilities. I couldn't see much of bank borrowing, so they should be really cash rich. Let's see what was their cash and cash equivalents. They should have had a significant amount of cash. Amazing. Look at this. It was like 13,562 crore cash and cash equivalents. They are sitting on cash. And that just got increased in the current year. It is 17,612. Okay, that's why we call these companies as cash cows. Yes, and they have substantial trade receivables as well. Okay, let's try to understand them, and let's just glance through the statement of profit and loss. Then we'll get into the fundamental ratios. Okay, if you look at their revenue from operations, yes, there is an increase. Other income slightly it has come down, but overall total income has increased from 81,747 crore to 83,379 crore. And they are spending more than 50% of their income on employee benefit expenses. Then they also have expenses on subcontractors, travel expenses, on software packages. They spend more than 2,000 crore. Consultancy close to 1,000 crore. That has actually come down. Last year it was 1,066 crore. Then something on depreciation, and finance cost is very minuscule for them. It's hardly 126 crore. Given their size, it's very small because they are managing everything on their own. Then some other expenses, but still their total expenses is only 63,000, say 64,000 crore. Income is 88,000, and that gives them a profit of 24,477 crore. Okay, and that has increased when compared with the previous year. Amazing. And current tax, yes, it has to be provided. And after that, profit after tax is whopping 18,000 crore.
When compared with previous year, it is 15,543 crores. So there is a significant increase. Then we have all this other comprehensive incomes, and if you adjust for all, still, yes. Let us also look at their EPS, earnings per share. In the previous year, their basic EPS was 36.34, but in the current year, this has increased because of increase in profits. Diluted is 36.32, and here it is 42.33, not much of difference. Good. So we have just glanced through the basic information. Now let's try to capture them. Let's first find out what is the movement in sales. Movement in sales, this is 2021, 2020. 2020 it is 79,047 crore, and in 2021 it is 85,912 crore. So what is the increase? Increase is 6,875 crore, and if you express that in percentage, this has increased by 9%. Okay, rounded off to 9%. Okay, now let's also measure their profit margin. They should be having amazing profit margin. So profit, when I say profit, we'll consider profit after tax. Profit after tax, previous year profit after tax is 15,543 crore. Current year it is 18,048 crore. We'll compare that with sales. Okay, so this is basically sales or revenue from operations. So I'll take revenue from operations here. Okay, now let's express them in percentage. So it is 21%. 21% in the current year. Previous year it is 20%. Okay, so there is 1% increase, and look at that 1% increase size. Okay, so when there is a 1% increase in profit margin, it actually increased by, say, somewhere like 2,500 crores. Amazing. That's on the profit margin. Let us also calculate EBITDA. So for calculating EBITDA, it is basically earnings before interest, depreciation and taxes. For that we have to take profit before tax, then we'll add depreciation, amortization and interest. Okay, profit before tax 24,477 for the current year, 20477 for the previous year. With that, let us add finance cost. I'm assuming this finance cost is interest cost, but it can be something else also. For understanding purpose, I'm limiting here. Otherwise, we have to go deeper into the schedule, and then we just have to pick up the interest cost. So it is 126. I have that here, 126 and 114. Then let us add depreciation and amortization. Depreciation and amortization, and let's see. It is 2321 and 2144. 2321 and 2144. Okay, so this makes, now let's just sum them. So their profit before tax is 24,000, but after giving effect for these two items, their EBITDA is actually 26,924 crore, and previous year it is 22,735 crore. Okay, let's try to express EBITDA margin also. EBITDA margin, it is 26,924 divided by revenue from operations. So it's actually 31.33%. We'll say 31%. So EBITDA margin is 31%. EBITDA is not only compared with sales. See, look, there is an increase. From 29%, EBITDA margin has increased to 31%. Okay. This EBITDA can also be compared. This EBITDA can also be compared with total assets. It can be compared with total capital employed in the business. So that will give you return on capital employed. Okay. Let me just measure that return on capital employed. For that, I'll take total funds infused in the system. Yeah. So here, if you see total equity and liabilities. So we'll take total equity and liabilities, which is 93,939 81041. This is total equity and liabilities. And now we'll calculate return on capital employed also. That's basically this EBITDA. See why I am taking EBITDA and comparing it with the return on capital employed. This EBITDA is the profit before interest. So the numerator is before interest and the denominator includes all liabilities, which includes debt funds also. Okay. So EBITDA divided by total equity and liabilities, and this business is actually generating a return of 29% on the overall capital employed. On the overall capital employed, previous year it was 28%. Okay. Let us also try to measure what is the return for equity shareholders, okay, ROE, and how do we measure that? We take profit after tax minus preference dividend, and that can be compared with equity. Okay, for that we need profit after tax, okay, minus preference dividend. Let's see whether there are any preference dividend. Let's go to this. I couldn't trace preference, so I'll take this profit after tax as it is. Already we have that. So this is profit after tax, okay, and that we can compare with the equity shareholder funds. For that, let's go here. Yeah, here we have the total equity. Okay, we'll put that. It is total equity 71531 and 62234. Okay, now we'll be able to measure return on equity. Return on equity percentage, it's 25. It's 25%. Current year, previous year also it is 25%. Okay. Let us also try to understand their liquidity position. Actually, they need not worry much about liquidity because we have seen the amount of cash they are sitting on. But let's measure that. Basic ratios. Current ratio. So we need their current assets. We need their current liabilities. Okay. I think here we have their current liabilities. Total current liabilities is 17,622 and 15,220. Okay, that's about current liabilities. Let us also have a look at their current assets. Yeah, here we have the current assets. It's huge, 48,282 crore and 43,820 crore. Okay, now let's calculate the current ratio. Current ratio is nothing but current asset by current liability. So 48,282 divided by 17. So it is 2.73. So whoever have listened to my current ratio, I used to say like current ratio above 2 means they are carrying idle resource. They don't know what to do with that resource. And that is visible even in case of Infosys. They are carrying idle resource. They don't know what to do with so much of cash, and that's why they are going for buyback. Even in 1920 they had a buyback, right? And even for 2021 there is a proposal for buyback because they want to give back those free cash flows. Okay, so it is 2.74 and previous year it is 2.88. So look, so now it gets synced, right? Because they have so much of resource, not sure where to deploy them. So this gives rise to the message that why to carry the idle resource with them when they could not find an investable opportunity. Better give it back. Better give it back to the investors. And people who got it in ESOP and all, yes, it's going to be cash rain for them. Okay, that's about current ratio. Let's try to understand how their net working capital will look like. Net working capital is something like this. Current asset minus current liability, 30,660 crore contribution. Previous year it is 28,600, and if you express that in percentage, net working capital as a percentage of current asset, they are contributing 63% 63.5% or 64%. It means long-term funds of 64% is available or is used for creating the current assets. Current ratio logic of 1.33 says there should be a minimum 25% long-term fund contribution from the business unit. Here they have surpassed it. They have surpassed it so many times. Look at this. They have 65%. Previous year it was 65%. Current year it is 64%. Because of this, we should not worry at all. We should not worry at all. Okay, because they have so much of resources. Even if it comes to 50%, 40%, we need not worry because their fundamentals are really, really strong. Okay, that's about current ratio. Let us also just touch on debt equity ratio. Okay, this will show how strong they are once again. Current ratio convinces about their short-term solvency. See, short-term solvency is like this. What does current ratio means? If they have to settle 1 rupee in the current year, they have 2 rupees 74 paise with them. So even after settling 1 rupee, they'll have 1 rupee 74 paise with them as surplus. Okay, that's what current ratio means. Let's look at debt equity ratio. In debt equity ratio, we have to take debt. Debt means total outside liabilities. Equity means all equity, capital, reserves, other equity and all. Okay. And here, while computing the equity, if there are any intangible assets, that will be generally deducted, especially intangible assets in the form of softwares and all. The assumption is it may not be saleable. It may not be saleable to anyone. It will not fetch any value. So that's the conservative assumption. That's why in equity it has been deducted. Okay, and it is the formula practiced by most of the bankers. Okay, let's take total outside liabilities. Let's go to balance sheet on the equity side, equity liability section. Yeah, total equity. Let's write this. Then any adjustment will do. 71531. Previous year it is 62234. And total outside liabilities is going to be simple. You can just take this total. From this total, subtract this. Okay. We'll take 93939 minus 71531. And here it is 81041 minus 62234. So look at here. Total outside liabilities is very small when compared with equity. This company grows every year on account of profits that is getting retained. Because look at their equity share capital, it is only 2,130 crore out of 71,000 crore. It means every year profits are getting retained because look at the kind of profit that goes and gets retained. Look at their profit after tax, 18,000. The previous year it was 15,000. So imagine every year 15,000, 18,000 getting added under equity. Obviously their equity size will increase. Okay. Now from this equity, let us subtract intangible asset. Of course, for Infosys, intangible assets will be their core assets. Here for a top layer level understanding, I'm just doing this deduction. If we go deeper into the schedule, probably the need may not arise. Okay. So here from the 71531, I'm deducting the 67 crore. And in the previous year, from that 62234, I am deducting this 48. I'm also going to deduct this goodwill. These are all the acquired goodwills. So these ratios, that is debt equity ratio, we are trying to measure what? Long-term solvency. So the assumption is in the event the business coming to end, whether these assets will fetch any value or not. If a business is coming to an end, then some intangible assets will not fetch any value. Goodwill may not fetch any value if the business is forcefully coming to an end. So on the conservative assumption, I'm also deducting that goodwill 167, and here in the previous year it is 29. I have deducted in both the years. Then if there are any revaluation reserve included, that should also be deducted. So here let's see, other equity has 69,401 crore. Let's go to other equity and see. I'm just going through the statement of changes in equity for the year ended 31st March 2021, and here this is their equity share capital. The other equity has increased because look at their opening balance. It has composition like securities premium, retained earning, general reserve, share option outstanding, then cess reinvestment reserve, capital reserve, other reserve, capital redemption reserve. So far it does not include revaluation reserve. It has increased mainly on account of profits. So there is no revaluation. I also just tried searching revaluation reserve. It is not found. Okay, so we can conclude with that now. So let's calculate now. Total outside liabilities divided by equity, and we get a ratio something like this, 0.32. 0.32 in the current year, and in the previous year it is 0.30. Amazing. See, the ratio is below 1. Banks, they say 1:1 as the good ratio. They will have maximum like 2:1 or 3:1. And this is a company which is having a ratio below 1. It means their long-term solvency is very strong. So what this ratio means? This ratio means for every 1 rupee of equity, they have a debt of only 32 paise. For every 1 rupee of equity, they have a debt of only 32 paise. In the previous year, it was 30 paise. In the current year, this has increased slightly. Yeah, you could see that total outside liabilities has increased over the previous year, but still it is a really comfortable situation. Really comfortable situation. That's about debt equity ratio. So in this session, I have covered only the fundamental ratios. Okay, basically the debt equity ratio, current ratio. Some of you may even ask, what is the need for analyzing this company which is fundamentally so strong? Okay, but let us also have a picture of those companies as well. Look, their long-term solvency is really comfortable, short-term solvency is comfortable. They are generating a return of 25% on the overall capital employed, and their EBITDA margin, they are generating a return of 29% on overall capital employed and 25% for the equity shareholder funds. EBITDA margin is 31%. And if you look at their profit margin, it is 21%. Revenue has increased over the previous year period by 9%. Profit margin, I believe it is more or less same, right? Yeah. Profit margin, previous year it was 20%, the current year is 21%. There are many other ratios, factors we can make use of to understand. We'll do that in later part.
Come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2,000 rupees. But for you, I'm going to give you a special offer.
Here we go. Banking credit courses bundle. This includes course number 1, banking credit analysis process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2. That is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis, and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like auto credit facilities, letter of credit and all. So far I have introduced 7 courses of 1,999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, collateral securities, a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over, some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.